How fast is inflation falling? How do central banks react to that? And how are corporate earnings developing? These are difficult questions. Questions I will discuss now with Felix Brill, the Chief Investment Officer at VP Bank. Felix, the equity markets don't believe in a recession, and VP Bank doesn't trust the equity rally. Why are you so pessimistic?
Well, I think the recent rally in equity markets has not only been fueled by that hope for a soft landing so that we can avoid a recession, it had also a lot to do with the expectation that the Fed is going to pivot later this year, but that doesn't add up. So if there's really no recession, why should the Fed cut interest rates? So therefore, we remain cautious with equities.
And how will the inflation rates develop over the year in the US and in Europe?
The easy answer to that is that inflation rates will continue to fall. I think that's a safe bet to do right now. It's getting a bit more complicated if we have to assess how much further, how fast, so there's still some uncertainty to that. At least we know that one very important driver of inflation, namely shelter, basically everything related to housing in the United States, that this factor is going to be weaker going forward. So we can expect lower inflation there, and this would be positive both for the headline rate, but also for the core rate.
And how do central banks react to falling inflation rates?
I think they will monitor these developments very closely. They've stated time and time again that they will very much monitor all the incoming data, because they have to be sure that they can really give the all clear on inflation. For us, this means that the Fed is going to do another hike in March by 25 basis points at least, and then go into a wait-and-see mode, watch the incoming data. For the ECB, we expect 3 additional hikes, 50 basis points at the next meeting, and then 25 each at the next meetings, bringing it to 100 basis points in total.
VP Bank tactically prefers bonds over equities. Which bond segments are still attractive?
We think quality is key in the current environment, so we prefer investment-grade bonds. And on top of that, we also like emerging market bonds, because we have seen quite some improvements over recent years in terms of structural changes, and with all of these changes basically improving the quality of the overall market, which we like in the current environment. And on top of that, we like that the weaker dollar typically is positive for emerging market bonds. Having said that, we advise always to invest in emerging market bonds only in a diversified way.
Thank you, Felix. That concludes our View the Questions. I hope you will join us next time again. Until then, goodbye and good luck.